We live in an age of seemingly rapid change, from technological advancements that boggle the mind to turmoil in various parts of the world. Prognosticators abound. It seems another black swan event similar to 2020 is right around the corner, ready to usher in a stock market crash and perhaps the worst economic downturn since the Great Depression. If these gloom and doom predictions come true, could the stock market crash and never recover? Let's find out. First, I want to stress that I am not a financial advisor, and everything in this video is for entertainment purposes only. I'm just some guy on the internet, and what you'll hear is just my opinion. Before making any financial decisions, do your own due diligence or consult your financial advisor. Stock market crashes are nothing new. The cycle of boom and bust has been happening for a long time. According to the book Boom and Bust, A Global History of Financial Bubbles by William Quinn and John D. Turner, there have been crashes since the popping of the first documented financial bubbles in 1720. The Mississippi bubble in France and the South Sea bubble in the UK both had catastrophic results for the investors involved, but in those cases, it didn't cause a post-bubble financial crisis. That didn't occur until 1824 during the mania in the UK for mining companies. By 1825, several banks in England had collapsed, unsettling the money markets and the Bank of England. There were also runs on other banks and subsequent failures. A bank run refers to a situation in which a large number of depositors rushed to withdraw their funds from a bank simultaneously. Things got so bad that there was a day, December 14, 1825, called the Day of Terror. In the week after that fateful day, banks all over England and Wales faced drastic runs, leading to 18% of the banking system to fail. The fallout from this was dire. The money supply collapsed. Merchants and entrepreneurs couldn't borrow money. This led to widespread bankruptcies. GDP contracted by 5.3%, which might not seem like much, but keep in mind that from 1800 to 2010, there have only been 3 years where the fall of GDP was greater. Eventually, the economy and stock market in the UK recovered, and some acts were passed, which had unintended consequences and ended up making bubbles more common. This bubble also marked the birth of financial journalism. Following this crisis and recovery, there were many other crashes, which resulted in financial crises. The fallout of the UK railway mania and the Australian land boom, and the Great Depression and the Great Recession. There have been 2 world wars and many conflicts outside of those periods. There have also been flash crashes like in 1987 and 2010. Out of all of this, the stock market always eventually recovered. Now, before we can talk about whether or not the stock market could crash and never recover, we must understand a bit about how stocks are valued by market participants. So, who's participating? There's mom and pop investors. These are folks who invest passively in the market via mutual funds and ETFs in their 401ks and IRAs, for example, or they might buy and sell individual stocks. Then there are fund managers and institutions, such as BlackRock and Vanguard. These are the big players that have massive sway over the markets. These big players make large buy and sell decisions, and it's not at random. But when they make these decisions, they greatly affect the market. So it's important to understand what factors they use when making choices on what to buy and sell. There are 4 methods of analysis that these institutions employ. The first method is technical analysis. This approach involves analyzing stock price patterns, trends, and trading volumes to predict future price movements. Elements of technical analysis include price charts, volume analysis, identifying patterns in candlestick charts, and using momentum indicators. The next method is sentiment analysis. As the name suggests, this approach focuses on gauging market sentiment and investor psychology to understand the overall mood and expectations related to a particular stock or market. Sentiment analysis involves monitoring news and social media, conducting surveys and polls, and examining the behavior of option traders and implied volatility to gauge market sentiment and expectations. The third approach is quantitative analysis. This approach involves using mathematical models and statistical techniques to analyze vast amounts of historical data and identify patterns or correlations. Quantitative analysis includes statistical models, algorithmic trading, and data mining. And finally, there is fundamental analysis. This is when you evaluate the intrinsic value of a stock by analyzing financial statements, company performance, industry trends, and economic factors. Key elements of fundamental analysis include the review of income statements, balance sheets, and cash flow statements, as well as considering financial ratios such as price to earnings or PE, as well as management and competitive analysis. I know it's a lot, but you don't have to understand what all of that is. It's just to illustrate how much goes into these decisions these large companies make. And there's a lot to each method of analysis, which is way beyond the scope of this video. The important thing to understand is that there are professionals employed by large institutions with trillions in assets under their management who use these methods to make buy and sell decisions. This is all relevant when considering the idea of the stock market crashing and never recovering. But for the sake of this video, let's just focus on fundamental analysis. In a previous video, I discussed a lesser-known strategy that falls under the fundamental analysis umbrella, dividend yield theory. So, what is a dividend and a dividend yield? A dividend is a sum of money paid regularly by a company to its shareholders out of its profits or reserves. And a dividend yield is the dividend expressed as a percentage of a current share price. So, for example, if a company pays a dividend that adds up to $5 per year and their share price is $100, then they have a dividend yield of 5%, 5 divided by 100. Dividend yield theory, or DYT, has been around since the 1960s and was popularized by the 1966 book Dividends Don't Lie by Geraldine Weiss and Janet Lowe, as well as the IQ Trends newsletter. So, what is dividend yield theory and why is it important? The idea is that dividends cannot be faked, like earnings can be. Either the money is paid out to shareholders or it isn't. Dividends are therefore an accurate gauge of a company's financial health and stability, indicating their ability to generate consistent cash flows. The longer the company has been paying undisrupted and rising dividend payments to their shareholders, the higher their perceived quality. In other words, people feel safe when investing in these companies. Examples include Johnson & Johnson and Microsoft. So the basis of dividend yield theory is that an investor can use the historical dividend yield for an individual high-quality stock to determine if it's undervalued or overvalued. They would then use this information to make their buying and selling decisions. Now, there is a way to use DYT when analyzing the market as a whole. We can use historical dividend yield data on the Dow Jones Industrial Average to determine its high and low range, and this can be used to determine if the overall market is historically undervalued or overvalued. Dividend yield and asset price have an inverse relationship. In other words, when prices go down, dividend yields go up. Let's go back to our previous example of the $100 stock having a $5 per year dividend, which means it yields 5%. Suppose that stock's tank, going down to $50 a share, but still paying out that $5 per year since it's a rock-solid company with a product people actually want or need. The dividend yield would now be 10%. So you could buy shares at the lower price and get more money in dividends for every dollar you invest. As the stock keeps going down, the dividend yield would keep getting higher. This would attract bargain hunters and those who can recognize good value when it's on sale. When this happens to a lot of stocks at the same time, it typically coincides with market bottoms. The opposite would then be true. Low yield occurring when prices are high, which would coincide with market tops. Okay, so we made it through. Hopefully it all makes sense to you, but even if you're confused by any certain point, the most important thing to remember is that dividend yields going up makes the stocks of high-quality companies more attractive to investors. This would then halt any decline in price, marking the bottom, and then the price of stocks would go back up, and the yields would go down, so long as the dividend is maintained. Recovery would be inevitable. I believe that without exception, during a catastrophic collapse, the stock market would eventually recover. Sure, company earnings would probably decrease substantially during the downturn, depending on the sector they operate in, and dividend payments would likely be cut or even halted completely. But eventually, earnings would recover as consumer demand improved, and as a result, dividend payments would be likely increased or reinstated if they had been halted. And due to investor sentiment being pessimistic during a prolonged downturn, stock prices would likely remain suppressed even as dividends were increased. This would result in ultra-cheap asset prices. Remember, if individual stocks or the market in general get too cheap, Those institutions and individual investors using any of the aforementioned methods of analysis would know that these assets are undervalued. This would prompt them to eventually start purchasing shares, pushing the prices back up until the market topped out again, leading to another downturn. As I stated earlier, this has been happening over and over again for a long time, and we always eventually come out the other side, with the stock market roaring to new highs. To summarize, when markets crash, assets eventually get too cheap to ignore. This attracts buyers, which increases the price of those cheap assets. Now, this process can take some time, depending on the situation we're in. It could be a prolonged depression, like in the 1930s, or a relatively quick recovery, like after the subprime bubble popped, or a V-shaped recovery like we saw in 2020. What about a worst-case scenario? I could see something like a grid-down scenario causing a crash that takes years to recover from. Whether caused by a solar flare, nuclear EMP, or a cyber attack, our financial markets would come to a halt, and the stock market would take a long time to recover back to today's levels. But even then, after the restoration of the grid, the markets would eventually be revived and innovation would continue, leading to new highs in the stock market. Not only this, I believe valuations would be even higher than they are today, under the following conditions. 1. There are markets in which people can freely participate. 2. There are divisible assets that have a certain level of marketability. 3. There is the ability to borrow cheap money to use in purchasing assets. And 4. There is a certain level of speculation. Then, all it would take would be a technological innovation or government policy that would be the spark to fuel the next bubble. In a previous video, I go into further detail on the creation of bubbles, discussing the bubble triangle as described in the book Boom and Bust. The bottom line. In my opinion, as long as there are people living with a free market economy intact, there will be financial markets that will surpass the valuation of the stock market today. This would be a result of the expansion of human knowledge, creativity, and innovation. So yes, the stock market could crash and not recover, but it would be the result of a species-ending event or the elimination of free markets. In every other scenario I can imagine, the markets would eventually recover, reaching new all-time highs. So, what do you think? Could the stock market crash and never recover? Or will we, as human beings, be able to withstand any hurdle thrown in front of us? Please let me know in the comments below. Also, if you'd like me to make a video covering another topic, or expand upon anything in this video, please be sure to add that as well. Thank you for watching.